Now, what drives our interest rates, right? What actually drives the setting of higher interest rates or of lower interest rates? Well, the interest rates charged by banks is determined by a number of things, such as the state of the economy, right? Our central bank, like the federal government, can set the interest rate, which each bank uses to determine the APR range that they offer based on a particular consumer's credit worthiness. When the central bank sets the interest rates at a high level, the cost of debt rises. When the cost of debt is high, it discourages people from borrowing and slows consumer demand. Also, interest rates tend to rise with inflation. Okay, so it makes sense, right? As it is more costly to borrow money, right, that makes it more costly for people to finance assets. Therefore, they're not going to be going out and buying assets at such a high demand as they may have done previously, right? So it's going to slow consumer demand. And it also says that interest rates tend to rise with inflation. Well, why does that make sense? Because as inflation heats up, meaning the cost of goods and services in the economy is getting higher and higher, we don't want inflation to get out of control because it's going to be very difficult for wages and salaries to keep up with inflation over time if inflation gets too high and runs rampant, right? So we're not going to be able to afford the cost of goods. Okay, so what does the Federal Reserve do? What do central banks do? They step in and they say, well, we will increase interest rates, right, which will put a damper on demand, which will slow down the rate at which the cost of goods and services are rising, right? And so that's why they may increase interest rates. So to combat inflation, they may set high reserve requirements, tight money supply ensues, or there is greater demand for credit. In a high interest rate economy, people resort to saving their money since they receive more money from the savings rate, right? Because with our banks, right, our banks, the rate that they may offer us on a savings account, on a high yield savings account, is going to be directly tied to our Fed's funds rate as well, right? So people will save money instead of spend it. The stock market suffers since investors would rather take advantage of the higher rate from saving than investing in the stock market with lower returns. And the stock market would have lower returns because the cost of debt for companies has risen, right? So if it's more costly for companies to borrow, it's more costly for them to grow. And so they're going to have less opportunities to make certain returns in the stock market, okay? And then businesses also have limited access to capital funding through debt, which leads to an economic contraction, right? But economies are often stimulated during periods of low interest rates, as we are seeing right now, right? They are hoping that these low interest rates, that they stimulate the economy because borrowers have access to loans at inexpensive rates. Since interest rates on savings are low, businesses and individuals are more likely to spend and purchase riskier investment vehicles such as stocks. The spending fuels the economy and provides an injection to capital markets, leading to economic expansion. So this is also a big reason why we see the stock market has gone up during the coronavirus pandemic as well, because once rates were dropped, right, the stock market, it prices in future cash flows. Well, future cash flows are going to be impacted by cheaper money today. And so the fact that money is cheaper today, it means that higher cash flows will come later on. And when higher cash flows come, that makes the value of the companies in the stock market higher, right? And so people will flock to the stock market to try to take advantage of those returns. The important thing for us to understand is that we don't have control over interest rates, right? We don't have control over whether or not we're going to be able to take advantage of higher or lower interest rates at any given time, right? We thought interest rates were on the rise before the coronavirus pandemic. But obviously they were brought back down to earth by something that was unforeseen by everyone, okay? So we cannot control interest rates, so we shouldn't try to, right? We shouldn't try to play the interest rate game. So when you are paying off your debts, right, we're not just trying to refinance everything, although it can be helpful sometimes to refinance if it is, beneficial to you to do so, but you have to take into account the cost of refinancing, because refinancing is costly, especially for something like a home, right? But if it's relatively cheap to refinance something like student loans or something like that, then by all means you can do that to a lower rate. But the fact that we do not control interest rates makes it all the more important to not pay too much attention to them when it comes to paying off our debts. As we've talked about many times before, when you are paying off your debts, you pay off your debts from lowest amount to highest amount. You do not take interest rate into account unless the debts are relatively equivalent in value, right? That's when you would end up taking the percentage, right, the APR of the particular debt into account, because we are not concerned with any small amount of interest that you may accrue over a short period of time. We are trying to pay our debts off quickly, right? And so we don't expect you to have, these huge amounts of interest that you are accruing on anything over the time that you are trying to pay off your debts. We want you to get some small wins and then compound up on those small wins into the bigger and bigger debts as you move forward, okay? So yes, interest rates absolutely matter. Interest rates are important because interest rates, they can have a very big impact on our economy. They can impact whether or not we are expanding or contracting. They can impact whether or not people are going out and buying houses. They can impact a lot of things about people's financial lives. But the way that you can ensure that interest rates have as small an impact on your financial life as possible is to be out of debt, to purchase things with cash, and to focus on things in that way. Yes, interest rates can be very important if you're constantly relying on credit and you're constantly relying on borrowed money. But if you are relying only on your income, you're relying on the money that you bring in, then interest rates are going to play a very small part in your life, as they should. And you're not going to be at the mercy of our governing monetary authorities and the decisions that they decide to make.